Thank you very much for coming, Jason, Allen, John. For anybody who doesn't know, my name is Maurice
Just
Anderson.
talk to the mic. Talk to people.
Well, they're seeing it, right?
All right.
And it's a conversation between us that they're over here, right?
All right.
Okay, so for anybody who doesn't know you,
Yeah.
we're here just to have a conversation about the interest rates, right?
Yeah.
And how it's affecting interior residences.
Yeah.
So let's spark a conversation, really.
All right.
Anybody who doesn't know you, tell us about yourself. Who are you?
All right. My name is Jason Allen John. For those that don't know me, I'm a mortgage broker. I've been working in the finance industry for about 20 years now. It's the funny thing. It's the only thing I know. I had to do a resume for something the other day, and I'm like, how long have I been doing this? 17 years old is when I started working in a bank.
Well, you're like 25, right?
Huh?
You're like 25 years old.
Yeah, so 25 plus, yeah. So I have my age out there now. But anyways, I've been doing mortgages for a while. I love it. It's a passion of mine. Not only do I like working with clients, I like just talking about it. And so this conversation is going to be cool. We could talk about all things interest rates. I know interest rates have been very dramatic, to say the least, over the last 6-7 months. So it's good to, explain what's going on and kind of, see how people can navigate the interest rate environment.
Well, for me, I'm not a numbers guy,
Yeah.
which is why I'm not a financial expert. I just like looking at houses. But what about finance, gets you going, really?
Well, you know what? To be honest with you, we live in what they call a debt-based society, right? Our whole world runs on debt. If you think about it, the governments borrow money to build our roads, to build our hospitals. We borrow money to buy cars, to buy houses. So if without debt, in a weird sense, nothing works.
Yeah.
No one buys anything with cash if you think about it. Obviously you buy some stuff with cash, like groceries, everyday stuff, but in reality, any big item you have, you use credit. So it's important to understand how to utilize credit wisely, and even just to function normally in society. So I feel like there's not a lot of education on just credit on itself.
You touched on a couple of things, how we basically operate in a country full of debt.
Yeah.
I mean, I believe we borrowed a lot of money during COVID.
Oh yeah.
But even to purchase big items, they don't really like it when you purchase it with just cash, because then a lot of questions pop up. I mean, how can somebody navigate those circumstances?
Well, the system unfortunately doesn't really work without debt, right? So that's why they encourage us to do that. And like you say, the government printed a lot of money during COVID to get us through, the tough times that was going on. So what's going on now is that when you print a lot of money, it causes what they call inflation. Because what happens is the more money that's in the system, it makes things less expensive or less valuable in a sense, right? So if all of a sudden everyone has money, then you're going to charge more for your services, I'm going to charge more for my services, and then it just starts going up from there, right?
We can't actually just print money. That's illegal.
I can't print money, you can't print money, but the government essentially can, because you know why? Because all of us pay taxes. So you can always print more money if you always are going to have cash flow coming in, right? It's almost like if you had an apartment building, then you could just be raise the rent at any time.
Yeah.
Because or you could just raise the value at any time because you're always going to get this money coming in.
For sure. I mean, there's a lot of people here in the audience who have one property, never bought a property, and want to be multiple property owners. So how can somebody navigate that circumstance, especially with the interest rate going up 5 times so far this year?
Yeah, 5 times.
5 times, potentially another one in October.
Yeah.
I believe there may be another one in December, depending on what the Bank of Canada decides to do.
Correct.
So where do you don't have a crystal ball. I'm not going to ask you to predict anything with 100% certainty.
Yeah.
But how do you see that work playing out, really, in our society at least?
Right now, the interest rates are affecting everybody. So what happens is it takes time for it to flush through the system. So they usually say if the Bank of Canada raises rates, it takes about 18 months for the whole effect to be felt, right?
I thought it was only 2 quarters, to be honest.
Well, 2 quarters in your mortgage payment, it gets adjusted. But then how long does it take you, say for example, your mortgage payment goes up by $1,000, right? So the first month, it's okay.
Yeah.
The second month, it's okay. by like the 6th, 10th month, all of a sudden, you know, that's an extra, for someone that could be $10,000-$12,000.
Yeah.
Now, when you've reached that, that's when your spending habits change. Because at first you're not going to change. You're like, oh, I can handle this extra $1,000.
Yeah.
And then after a while, so that's why they say it takes about 12 to 18 months for it to flush through. So unfortunately, they're raising interest rates faster than I think they need to. And what's going to happen is it's going to cause them to scale back because it's going to hurt the economy, which is not cool.
Yeah,
Because
not at
pain
all.
is coming. I hate to say it.
Nobody really expected it to go up so quick.
No.
Such a short time span, really.
But at the same time, no one expected it to go so quick down.
That's true.
At the same, you know, so even for myself, I'm gonna be honest with you, as a mortgage agent, I didn't think they would raise rates this fast. But I kind of like, in hindsight, which is always, you know, 2020. I'm like, I should have realized if they brought it down this fast,
Yeah.
they could bring it back up as fast too.
I mean, to be fair, that's not really a fair statement for yourself to judge yourself like that, because I mean, the Bank of Canada themselves said they weren't going to increase the rates until 2023,
Yes.
and we're in 2022.
And that's the same thing I was
Yeah.
saying. So at the beginning of the year, I was telling clients, they come out and said that they're not raising rates till 2023.
Yeah.
And lo and behold, they had to change because technically Bank of Canada is what they say data dependent. You're going to change based on the data. So if you get new information, you're going to make that change, right? So when you talk about like homeowners and potential buyers, the good thing is, in a sense, if you're someone that's trying to get into the market, whether it's a rental property, prices have kind of come down a bit. So even though interest rates have gone up, the mortgage payment that you're going to pay on the house might be equivalent
Yeah,
because the
depending on
price
the
might have
price,
gone
okay.
down.
Yeah.
In some markets, not everywhere, right? But then rents have gone up by almost like 30-40% in some cases, right? So it kind of offsets the balance if you're an investor. And if you're a homeowner that you didn't buy initially, then you have an opportunity now to potentially buy in, right? So I it's like, and I don't want to alienate the people that bought over the last year
Yeah.
that may have bought high, but then you may have bought at a lower interest rate. But obviously, if you took a variable rate, it's kind of affecting you right now.
I mean, talking about that, that's a good point you made. So I know the variable rates were heavy, at least, like I said, I'm not a mortgage expert.
Yeah.
Correct me if I'm wrong, but starting like March 2020, when the Bank of Canada and the government reduced the interest rates, there were a lot of people starting from March 2020 until now, which is a 2-year span,
Yeah.
that took variable rates because it was basically free money. right?
Well, I wouldn't say they took because it was free money.
Yeah.
They took because over the last 20 years almost, variable rate has won in a sense, right? So it's like, it's been very good for people over the last few years that the rates have been always kind of going down. So if you took variable, in most cases, the last 20 years, you kind of won.
Okay.
So that's why I always say to people, you don't want to just get so excited over the last 7 months.
Yeah.
Because if you think about the last 20 years, it's been like really good. So who knows what is the normal trend? And I think the normal trend is they're going to revert back to maybe you'll see like, I think rates will fall by maybe 1.5% to 2% over the next 18 months.
Okay.
It's gonna go up maybe another 1.5, but it might come back down. So we might sit where we are right now, which they call a neutral rate where they're at right now.
So then I have a question for you. Just with conversations I've had with clients over the past 8 months,
Yeah.
a lot of people are nervous because the interest rate has gone up so much with them being on a variable mortgage. Do you recommend them locking it in or holding out, or is it just based on their circumstances?
Well, it all depends on their situation, right?
Yeah.
But to be honest with you, it might be a good time to take a 1 year or 2 year fixed rate
Okay.
because it then protects yourself from the rates going much further up. The other thing is a lot of people are on what they call a fixed variable rate payment. So your payment may have not changed over the last little bit, right? But then the scary thing with that is that if and when you need to remortgage or when the bank says you've reached what they call like a trigger rate or a trigger point.
Okay.
And what a trigger rate or a trigger point is where your amortization of your mortgage is actually higher than the contract rate. So basically you're only paying interest only.
Interest only.
And that's not great for a
So if
mortgage.
the mortgage was simple math, $2,500 a month.
Yeah.
Previously.
Yeah.
Interest rates went up multiple times. I'm paying $3,300 a month, $35. None of that is going to the principal.
No, what it is that you're paying $2,500.
Yeah.
Interest rates have gone up, but your payment stayed the same.
Okay.
So for example, when you start your mortgage, let's just say out of that $2,500, $1,700 is going to interest, and let's just say $750 is going to principal, whatever, right? As interest rates are going up, it's like $1,900, $2,100, $2,500, now $2,600. Now you're paying more interest than you're actually paying monthly, so you're not paying nothing down to your mortgage.
Okay.
So what happens every month is you go from 30 years, 31 years, 32 years, 33-year amortization, 35, right? So if you don't adjust your payment, you could blink, and in a year from now, you actually have a 40-year amortization. So then what's going to happen is the bank's going to call you, and they're going to be like, either you're going to have to put a large lump sum down to bring it back to 30 years, or they're going to increase your payment significantly, right? But some banks, they increase the payments as each step gone out.
Do you have to agree to that for the bank to do it, or they're just going to?
That's just their product. Okay. They don't. So I had some clients that specifically wanted to go to certain banks, so they wouldn't have to deal with these increases, right? But me, I don't like putting my clients in that because I know that the damage and effect in the future. So it's better you make the more payments, right? Because it's better for your long term, right?
Okay.
So I think the smart thing to do, if you're in variable and you don't want to go fixed, you should increase your payments yourself if the bank hasn't done it automatically, because that's to prevent yourself from actually, going through a situation when you're like, oh my God, my payments are going to go crazy, or like I can't afford it, right? So that's why I say it takes 12 to 18 months, because how long does it take for someone to be like they can't afford it? It takes a while, right?
Yeah. So with that being said, if they make those increased payments, are there any other ways that they can help bring the principal down with interest rates going up in addition to that? Or is
just
that the only
increasing
way?
your payments. That's the
Only
only,
way, right?
just pay more, right? Unfortunately, I hate to say it,
Yeah.
So you know how people say right now, they'll be like, work harder. So it's like the only way to really do it is, unfortunately, is paying more. So what we all have to do right now is be very aware of our budgets. So like now is the point in time for, all of us to really take in stock what we're spending our money. We might have to reduce savings for a certain period of time, unfortunately, right? Because you have to be able to pay these bills, these mortgage payments, right? So I would say if I was an individual in a variable rate right now and they haven't adjusted my payment yet, I would think about going into a fixed term, because that increase in that payment is going to shock you a lot, and then to catch up is actually a double shock.
Yeah. Okay, so that helps people who already has mortgages.
Yes.
What about somebody who sees the interest rates going up, reads all the news articles about buyer's remorse for people who bought 6-7 months ago, which in my opinion is not the case for a lot of people, because they typically buy with a long-term goal in mind.
Correct.
Not just speculative buying where they want to buy and flip. Those type of investors or buyers may not be doing it right now, but for first-time home buyers, how could they get into this market? And is it really a good time to get into the market from the finance side of it?
It's harder to get approved for a mortgage.
Yeah.
So in one case, I say it's an excellent time, because if it's harder for people to get approved, that means your market base is a lot smaller.
True.
Right? So like less people are buying.
Yeah.
And if people are selling, unfortunately, they want prices that were in the past, and they may not get it.
Yeah.
So what will happen is, I think we're still running into a problem in Toronto. No matter what, there's a supply issue, right?
Definitely.
So if all of a sudden now, 7 months ago, you could have got $500,000 more for your house, you may now not want to sell it if it's selling for less. You're like, no, I'm going to wait for the market to come back up, right?
Yeah.
So if a first-time buyer, you need to search for deals. I think there's going to be a lot of assignment sales for these individuals.
There is, yeah.
So I think this is where your opportunity, you might be able to buy something that someone bought in 2017 and buy it for the price that they paid.
I've actually come across a lot of options where I have some buyers that are looking for those same type of deals, and they were able to purchase a brand new condo that somebody purchased in 2017, like the Vaughan area.
Yeah.
For some of them at the same price,
Yeah.
some of them less than what they bought it for. So
Exactly.
obviously the seller is losing, but as a buyer right now, it's a great time to invest. Right?
Yeah, and at the end of the day, right now, especially the way your question was focused, we're talking about the buyers, right?
Yeah.
I feel sorry for some sellers in that case, right? And then that becomes the other issue. A lot of people bought these pre-construction condos and stuff like that for the reason to actually flip them.
Yeah.
So
like an assignment sale.
yeah, like an assignment sale. They're trying to just make quick cash.
Definitely.
And now they have to close, and now they may not be able to qualify.
Which is not the best reason, sorry to interrupt,
Yeah.
it's not the best reason to buy a pre-con with the sole intention just to do an assignment.
Yeah,
Because as we've had discussions before, we always talk about buying and holding. That's how
Exactly.
you create generational wealth.
yeah.
But just to go into a pre-con investment like that, not knowing what the future holds, I mean, look where we are today. We had the Ukraine war that has affected our economy.
Correct. Inflation,
Inflation.
right? And who knows what's next?
Exactly.
Right?
Like I just gasped. You can't see me if you're listening to this podcast, but I was stumped because anything that's happened over the past 2 years, in my opinion, it all started with Kobe. When he died, everything just went downhill.
With who?
Kobe Bryant.
Oh, Kobe? Oh, shoot.
January
Oh, you're looking
2022.
into Kobe?
I mean,
That's
January
scary.
2022, and then after that, like, COVID and everything else after that happened. But
I never thought about it that way.
I digress. But so for first-time buyers,
Yeah.
right, it's still a good time to purchase because the interest rate historically
Yeah.
is higher than it was 2 years ago, but it's not extremely high compared to what you said 20 years ago.
Yeah, like 20 years ago, actually, interest rates were probably very similar to what they are right now.
Okay.
I remember back when I started banking, prime was like around like 5.75%, and we're right now 5.45. So we're very similar to when I remember first entering into the banking industry.
Yeah.
But there's a lot of things that are different now than it was back then. We didn't have the population that we have right now. Like Canada's bringing in 3% of our population every single year,
Yeah.
which is insane. Which is a lot of people. Not
Numbers wise,
3%.
it's around 450,000 people
Yeah.
in the next 3 years.
Yeah.
Half of that is coming to the GTA.
Yeah.
Not specifically Toronto, but that's still a lot of people coming
Yeah.
to a designated area, which goes back to lack of housing supply, right? And the cost of it going up.
So if you're a first time buyer, why not take the stab and go in?
Yeah.
As long as you can afford the payments, right? I think that's what the issue is. Like
Yeah, okay.
everything's based on affordability at this moment, right? Because you can't buy with the intention that you think the price is going to go up in the future, like everybody was buying maybe in the past, right?
Yeah.
So how you buy is different. It's not to buy, it's how you buy. And maybe now you do a lot more joint ventures. Like you work with individuals and with people, with friends and family. Because I think that's the key at this point. Because getting qualified is getting harder and harder. So the best thing to do is to work with individuals that actually have the capacity to assist you, whether on down payment or even income.
So there's multiple different types of joint venture.
Yeah, there's many types of ways people can work together. Like I can invest into you and give you like a down payment. I could buy a house for you and we could structure it like a rent to own, and then you eventually will buy me out. I could come on a mortgage with you and we could co-own it. Or I could simply just be like a co-signer.
Yeah. Okay, so many different options for first-time home buyers.
First time home.
So I already have a home.
Yeah.
Interest rates went up, and I want to get my second door. I want to become a real investor.
Yeah.
From the second door, we can get a third, fourth, 100 down the road, maybe 5 years later. How can we do that
Right now?
right now?
Well, I think what's going to be key is that hopefully you have some equity, because it depends on when you bought.
Yeah.
Right? So let's just say you have a little bit of equity. It'd be a good opportunity now to tap that equity, because as we talked about, maybe buying a duplex would be amazing right now because the way rental incomes are, right? So there's a catch, right? As housing prices go up and to buy a home becomes more expensive, all of a sudden renting becomes more attractive. So it makes it a world where, as an investor, it's like, let's go, right? Because if you have access to capital right now, you might be able to get a property that rates could fall, but rents won't fall like that.
No,
And that's the
rents-
thing, like
yeah.
once rents are at a level, like you're not gonna get less rent per se, unless demand really drops.
That's very true. So what I've seen so far in regards to the rent going up, in some areas, as you mentioned, 30, 40%, in other areas around 20%. Bare minimum is 20% for
Yeah.
sure. So what happened in that situation is a lot of buyers that were going to purchase 6 months ago, when the interest rate started to increase, they became afraid, to say the least, psychologically, right? They didn't
Yeah.
know where the market's going. It's very nerve-wracking for them. So they're going to keep their money in their pocket. But they've been preparing for it for at least 5 years.
Yeah.
You know, you think about it, you research online, you're not ready to buy it, let me just see where the market's going, and then you jump. That's about a 2-year process, really, before you even act. But because the interest rates went up, those same buyers now are becoming renters. So renters are now in competition with people who have to rent,
Yeah.
but also buyers who don't want to buy, which
Yeah.
means they have great credit scores,
Yeah.
and a lot of excess liquid cash,
Good jobs.
and that increases rental rates significantly,
Exactly.
more than it would have been before if they were still buying a property, obviously, right?
Yep. And then a lot of people are starting to rent where they want to live and buy properties that they could turn as rentals, right? So now it changes that aspect, right? Maybe I want to live downtown, but I can't buy a condo for $1 million or whatever. So I go buy somewhere in Hamilton or Niagara, and then I could rent it out, take that additional cash flow, go rent, and like actually may have a better standard of living.
That's true. Good point. So I have a two-part question for you now that you mentioned that. The first would be, when it comes to somebody purchasing a secondary property with a second door, like
Yeah.
a duplex or even a triplex, does that income from the rent help them get pre-approved for the mortgage?
Yes, and
how
that's
much
like
do
the
they-
genius.
How much do they use?
In most banks, they use at minimum 50%.
Okay.
Some banks will go up to 80%, but like majority of them is 50%.
Okay.
So it is. It's a that is the hack, right? Or you know when people even call about house hacking.
Yeah, that's true.
You could rent a part of your home. I could use that rental income into your mortgage qualification and it help you approve for a higher mortgage. That's almost like a cosigner in a sense.
So is that the same case if I was to buy a property that has maybe like a low rise, 6 doors or more?
Yeah.
Or does a percentage that's taken and the qualification is totally different now?
It changes after you get to 4 doors with most banks.
Okay.
Then what they call it. It becomes a commercial property.
Okay.
So your actual income doesn't matter as much as the income from the property. So it actually makes it a little easier to qualify.
Mm-hmm.
But what happens is sometimes the down payment's a little higher because the way they appraise multi-unit.
commercial.
Yeah, they don't praise. They praise multi-units based on income, not on value. But then people price based on value.
Yeah.
So there's
So kind
usually
of like
a discrepancy.
what we call a cap rate, basically.
Yeah, based
right?
on a cap rate.
Okay.
Exactly.
Okay. That's interesting. So okay. So let me just clarify. So what you just said was if it was a commercial property,
Yeah.
4 doors or more, not 5.
4 or more.
4 or more.
So that would be 5,
They'll
6,
be able
7,
to
8.
take how much percent of that, or is it all of the income from the?
They'll use all of the income.
All of the income, 100%.
right? But then what will happen is that it's sometimes difficult because like I say, the value is based on the income,
Mm-hmm.
and when you do the value based on the income, usually the purchase price is much lower than what the bank would mortgage for you.
Okay, like an assessment value.
Yeah.
Okay. All right. So with areas like St. Catherine, Niagara Falls, I had a client that I was looking up properties for, an investor. They needed a minimum of 2 doors, and there's a lot of properties in those areas, anywhere from $650 to $850 a month, with great return on your investment because you have a good portion where you can use as income potential.
Okay, yeah.
Basically, would you recommend somebody purchasing, I guess, for passive appreciation when you're doing investments, or more so just cash flow?
Well, I think cash flow at this point and juncture where we are is
Yeah.
more important than passive appreciation because
Okay.
you don't know. Like interest rates could spike up to 10%, and that kills any sort of passive
I
appreciation.
mean, hopefully it doesn't go up to 10%.
But I'm just saying, like at this point, like
Yeah.
you just really don't know what's the next thing that could happen, right?
Actually, so for anybody who's listening and anybody who may not know, just clarify the difference between passive appreciation and what cash flow really is.
Okay, well, passive appreciation is like over time you you pay down your mortgage. Or sorry, passive appreciation is as time you pay down your mortgage, which increases like equity in the value of your property, right? Cash flow is the difference between what your expenses are and what you're bringing in your income, and that's that difference that you get. So the thing about it is with mortgages, because there's a requirement for you to amortize it down or pay down the debt, there is some appreciation that appreciates over time. And that's why real estate is so powerful, especially if you have a tenant. Like you could hold a property for 25 years and the mortgage goes to 0. And then you have access to that passive equity in the future.
Okay, thanks for the clarification. Another one that I personally want to know about, bond rates.
Bond rates.
Go ahead, please.
Oh, my favorite.
Bond rate.
Okay, so a bond is essentially a loan, if you want to break it down. So I give you a loan,
Okay.
and we have a contract. Technically, we have a bond and an agreement, right?
Okay.
So in a bigger scheme, a mortgage is essentially like a bond, right?
Okay.
There's an agreement, there's a state of interest, there's a term, and all that kind of stuff. Now, the government also issues bonds to fund, like I said before, like roads, hospitals, teacher salaries, stuff like that.
Okay.
So as bonds that the government releases are basically what they call the safest investment you can make, because as we spoke earlier, is that they have the tax base of the population that they could always tax more to pay off their bonds, right?
Okay.
So because bonds that are issued by the government are the safest investments, our mortgages rates are priced in these bonds. So there's a spread, and that's how banks make their money. Banks make their money from what they go out to the market and borrow money from and what they charge us. And that's how the world kind of works in essence, right? Banks will issue bonds. So say, for example, you need a $500,000 mortgage.
Okay.
The bank will go to the market, go get a $500,000 mortgage. They may pay, like right now, 4%. And then they'll come to you and they'll be like, Maurice, I'm going to charge you 5.5%. And they make that 1.5% on you.
So correct me if I'm wrong. Was it that they purchased a lot of bond rates at the beginning of COVID, or they sold a lot of bond rates at the beginning of COVID?
No, what they do is so Bank of Canada, the way money is created from a loan, essentially, in a weird way. So I know that everyone's like, oh, they print money. They don't really print money. The way money is created is that the Bank of Canada creates reserves for the banks, so the banks could lend more money.
Okay.
So the way money is created is that as a banker, I'll lend you money to buy that home, and now all of a sudden, that money's created because that value of that home is associated with the value, and that's how money is created. So what Bank of Canada does, it loosens conditions to allow the banks to lend more money.
So that's what they did.
That's what they do so when they say they're not printing money, they're kind of buying bonds, and they buy bonds from the market to lower the price, right, at a stipulated interest rate.
So that's what they did at the beginning.
So in COVID, they just went out and they started buying all the bonds in the market and then like flooring the rates, right? Because when you hear Bank of Canada changing the rates, it's called the overnight rates, and that overnight rates is how they lend money to the banks for their reserves. So, but they don't really control the long-term rates. The long-term rates are controlled by the bonds, like how you feel like. So if I lend you money and it's to say 1 year, you'd be like, okay, I'll take 2%. And if I say I'm gonna give you the money in 10 years, you might be like, I want 5%, because you want more money because of that risk premium, because of the time it's gonna take for me to pay it back. Okay. So usually what you see is that as the longer we go, like 5, 10, 15 years, the rate should go up, right? But right now we're in a period where like actually the 10-year rate is actually lower than the 2-year rate, which means in a weird sense that we're heading to bad times. Because that's where I'm thinking like, oh, in the long term, you're probably not going to be able to pay me back. So the rates start to decrease, right? But in the short term, the rates are increasing because Bank of Canada is trying to raise the rates on the short tail on the end, right? They're trying to control the long end rates, but they can't. So the only way they can really do it is buy bonds to reduce it. But they've come out and they said they're going to stop buying bonds.
That was my next question.
Right?
So they're stopping, and are they also selling the bonds that they purchased before, or?
No, what they do is that all the bonds have a maturity. So instead of like renewing them or buying new ones to replace it, they just kind of let them fall off of their balance sheet. So they don't buy new ones, and they also don't sell. They just let it, like, if when the bond matures, they pay back the money and they just don't replace it. Because usually what they do is they'll issue a bond and then they'll replace it. So for example, let's just say hypothetically, me and you have a bond together and I owe you $1,000. What I will do is I'll go raise another $1,000 and take that $1,000 and pay you. But what they're doing, they're like, okay, here's the cash. I'm not gonna go raise more money. Okay.
So you also mentioned that that's a sign technically of bad times to come.
Like a recession. Yeah. They call it like a yield curve inversion, because that's not, it should be that the longer the term is, the more I should want in return, not less.
So to my understanding, a recession basically has to happen with 2 negative quarters of productivity, right?
Yes.
Which we've had but a lot of people are not saying that we're in a recession.
Well, we haven't had that in
We haven't
Canada.
had that.
The U.S. has.
The U.S. has.
But we haven't had that.
Okay.
We have a decline in GDP, which shows there's a trend that we're actually lower. But the States have had two negative quarters, and they changed the definition the other day. So
What is the new definition?
I have no idea.
Oh.
They just my whole life it was two negative quarters, and now all of a sudden they're including a form of employment. Because usually when there's a recession, there's not a lot of jobs, and like the jobs are
We
down.
have a
But
lot.
now we have a lot of jobs and
Yeah.
a lot of employment. But
I think it's over 5% right now, I believe.
yeah,
Yeah.
and that's not like usually a recession would be like 7, 8, 9, 10.
Yeah.
So they're trying to say like it has to be a combination of job loss and productivity growth decline. So let's just see what happens in the third quarter.
Okay. Okay, that makes sense.
Yeah,
So we touched base on people who already have mortgages,
yeah.
people who want to get into the market as a first-time buyer. So what would be the last 2 tips that you can provide anybody in regards to the interest rates and, how they can curb?
I think the most important thing is to just get ahead of it. Don't let the Bank of
Get ahead of
Canada.
inflation?
No, get ahead of the potential rate increases.
Okay.
We know they may be increasing rates. So if you're an individual right now and you're in the market and you're on a variable rate, start thinking about paying more. Don't let the bank tell you to pay more. That's, I would say, number 1. Number 2, everybody has to look into their budget to see where they can find some cost savings and find areas in which they can actually reduce their expenses so they can be prepared for anything if rates still continue to rise, right?
Yeah.
Because what ends up happening is as rates rise, it affects everything that we do.
Down to groceries.
And that's what I'm saying, it takes 18 months because
Yeah.
it's like if I'm a juice supplier, right? The juice that I sold you in the stores now, I probably bought like the supplies 6-7 months ago, right? Now, when I'm buying the new juice, it might be more expensive. So now when I sell you this 6-7 months from now, I'm gonna raise that price. So it doesn't fully set in. So there's still more price increases to come. I think inflation's not gonna cool yet.
Yeah.
But then what's gonna happen is when it does cool, it's gonna fall bad, like an anvil. May even go negative.
Yeah.
And then that's when you'll see Bank of Canada start reversing. So I think the thing to look for too, the second point is when you see inflation start moderating and going down, we're not far away from Bank of Canada stop raising rates. So as right now, it's still kind of going up. So we don't think they're gonna stop. And then I think there's one more point I want to say. Everybody's saying something worse on the financial market is gonna happen. I have a feeling something's gonna break.
Okay.
Like these raises are going so high, but I can't tell you what's gonna break. But something's gonna happen.
If you had to guess,
I don't know. A country.
a country.
The default.
Okay.
I would say that.
I
A
can see
major country.
A major country.
And not like, we've heard Argentina, Italy, like these are still big countries, but we're saying like, I'm gonna say like something like crazy, like Germany. Probably. If my biggest prediction, it'd be Germany.
Germany.
And the only reason I'm saying that is because Germany is gonna go through the winter and all this stuff with Russia. So unless they can find a solution for that,
Yeah.
they could have a really dark winter. Where their energy cost is actually, in some cases, 10x. So
Would that also affect us in any way?
100%,
Yeah.
because the whole world is so connected because of globalization, right? So we're all connected in a way. We sell to Germany, we buy stuff from them, they produce things. So if they are not producing stuff that we need, like a lot of people have German cars.
Yeah.
So if all of a sudden the parts that all come from Germany
We've already
don't come
had
in,
issues with tech parts from cars to computers.
right?
over the past
Chip
years.
issues,
Yeah.
right?
Yeah.
So I think that may happen, right? Now, obviously, the other thing that everyone says the wild card is like China and Taiwan, but I don't think personally that's not ready yet, because I think China's seen what's going on with Russia.
Yeah.
So
I mean, the best way to try and help yourself or your family is to make sure that, I like to call it your own personal economy,
Yeah.
which is your own finances,
Correct.
are in order with some sort of a plan, basically, like you just mentioned, to help offset inflation, fight any circumstances that may come up in the future. Like you said, that hopefully the crash doesn't happen in Canada.
Yeah.
Right? So a real estate action plan would definitely be something that could be done.
Yeah.
But, I mean, I appreciate you coming here.
Oh, no problem, man.
Having a
I'm not trying to scare nobody. It's not scary. It's just more of to get prepared, right?
Yeah,
and
so-
understand what possibly could happen.
It's
you
kind of
know?
like, somebody who wants to buy a property but doesn't know where to start.
Yeah.
It's always good to start off at least with your credit score,
Yes.
credit report. You need to know where you are so you can get to where you're going
Exactly.
and, be on better footing, to say the least, right?
Yeah.
Okay. Does anybody have any questions for myself or Jason?
Yeah, same here. I'm looking here where we talk about the variable. So I learned a bit better that about the variable. Because they're saying if you have a variable mortgage, you can put some in when you want it.
Yes, correct.
So like, say I'm looking at it this way, if I have a variable, say at 2%,
Yeah.
and if I had borrowed the regular mortgage, that is 5%, that 3% I should work with it and put that into the variable.
Exactly, because you want to get ahead of it, right? Because
That makes
yeah.
sense, man, a lot of sense.
yeah, make a little bit of just a little bit of extra payment, right? Because it compounds, right? If you can faster pay down your mortgage, it benefits you in the future.
Yeah, and the
When
extra.
I have a mortgage, I used to pay every 2 weeks.
Yeah,
So a week goes in for you.
exactly. And the week goes in for the
your
bank.
principal.
Yeah, so it could even be a minimal amount. It doesn't have to be like $600-700. It could be
My
$100,
next
$200 a month.
question is for you. Why is it when you have a home, because this happened to me, my son and I was living together.
Yeah.
We bought a house for 15 years, he wants to leave.
Yeah,
So I could manage the mortgage on my home because I was retired then.
yeah,
So I went to the bank, which I have some money could pay down on a house if I want. They say I wasn't qualified. So I said to them, what if I rent a part of my home
yeah.
to help me keep the mortgage? Why is it that they don't take all of that money that you rent the place for?
It's interesting. You know why? One, because rent's not consistent. Like there could be vacancies. So when we were talking about like on the commercial sales, they account for those vacancies. The second thing is taxes, right? So if most of us here, anything we earn, the government takes 50% of it. So the bank is really on that because they're under assumption you have to pay taxes on that income that you bring in, which you do, right? So that's what it is. And you have to remember the banks are in the business of they're risk averse. So they try to do stuff. Not to say they don't want to give you the money, but they want to make sure if they give you the money, no matter what happens, you're going to be able to pay back,
That's
right?
right.
So
Because the correct person can quit on you.
could leave, right?
You can't afford the mortgage.
Yeah.
This is what they're looking at, is it?
Yeah. So they take 50% of that income because they know like it's going to be harder to qualify, but those who can afford to most likely pay that mortgage or that portion of the mortgage, even in the event that person is not paying you rent.
And I think I could manage because at the time my mortgage was just $100,000-something. But they didn't take it.
Yeah.
I had to sell it.
Oh, that's unfortunate. That's unfortunate. Any other questions?
So I have a question, I have a couple of questions. What's a typical credit score for a first-time buyer?
Anything over 650 is perfect.
Is it, that's still okay? Or
Yeah, that's okay. 650.
Oh, because this is the benefit of having a mortgage broker. So the banks typically want like 680 or more,
680,
right?
but you can go as low as
Yeah,
650.
650 is good too.
But it all depends. Like if you're putting less than 20% down, 650 is the minimum. But if you put more than 20% down, there are some people you can get mortgages with lower credit scores.
And additionally, I don't know if anybody knows, but with you going with a mortgage broker, the bank is just one institution. They're not going to promote any other interest rates, obviously, because they want the business for themselves. A mortgage broker like Jason, he has access to sometimes even up to and above 400 different lenders, both private and other resources that I'm
Correct.
not even privy to. But
Like B lenders?
Like a B lender, a private lender, a credit union, another bank. There's a lot of different institutions. The big banks do a great job of marketing themselves. So that's what all we see, right?
yeah,
Like they almost have like they call it oligopoly. Like they just run it. It seems like that's all that's there, but there's more choices. But they're just so big, so it's like it's hard to see through the noise of them.
yeah.
Yeah,
So like a 5% down, what would you say is?
like 650 minimum,
Just
yeah.
650, okay.
And it could always be for individual 650.
Rental properties, how many can you have? Because I heard one time there's a limit to how many you can have.
Well, they usually see each bank has their own rules. So some banks say you could only have what they say is 4 doors. right? But usually what they mean is with them. So you can have 30 properties, but you can have 30 properties with one bank. So you could have five, just keep going if you can afford it, right? And that's it. So there's no limit, but they try to tell you that stuff because what happens if you think about it, I used to work at a bank too. I want to keep you. So I try to not tell you, I'm not going to say to you, oh, you could actually buy 4 other properties. I'll say, oh, you can only have 4 doors, but it's only for, like, you know?
So when you say 4 doors, you mean, because I was trying to figure out what you meant by that.
So 4 doors, you could have a duplex, and some banks, like 2 units, will count that as 2 doors, but it's 1 house.
Because 2 different units.
2 different units. So they may say you could have 4 units. Some banks will say you could have 4 homes. Yeah, it all depends based on the institution.
And my next question I may ask is, say you have a mortgage and you, while you're paying, doesn't matter what your mortgage is at the time, and you find that you have some money that you could pay down on your principal, how many times a year do the bank allow you to?
Most banks, they allow you to put a 20% down as a prepayment without penalty. And they also allow you to some banks allow you to double your payments, some it's like 20%. Every bank has a different rule, but you can do it. And even if you do it and there's a penalty, who cares? Because you're paying your mortgage down, you're paying less interest, you know? They don't want you to do it because they want their money, right?
I just want to interrupt. I'm going to ask you 3 things at once. I don't want to forget anything.
Yeah.
So you said 20% down without penalty.
Yeah.
So if you want to pay more, they
Yeah.
can charge you a penalty for having to pay more
Yeah.
on your mortgage.
Yeah.
Really?
Number 2, actually start with that one first. Go ahead.
Well, basically, think about it. I'm banking on you giving me this interest over a certain period of time.
30 years. Yeah.
We entered in a contract.
Yeah.
Now you want to breach or change my contract. I'm going to penalize you.
Well, you're still getting your money though.
I'm not getting my interest. I want the interest. I don't
Yeah,
care about the
that's
principal.
true. Okay.
I'm here for interest. You pay me back, you're gonna have to pay me back. I don't care. I want my interest.
Okay. Touche. So then, with that being said, I think another topic that we didn't actually touch on that may help. Can you explain the difference between HELOC and finance? So HELOC,
Yeah.
home equity line of credit.
Yes.
And how it may benefit somebody in one way or another.
Okay, so there's several ways in which you could use your equity to do things. So you could refinance, which means remortgaging, taking a new mortgage and increasing your mortgage from one level to the next. You can get a line of credit, which just gives you access to additional equity, right? Another way you can do is you can get a private loan that will use your home as collateral and provide you with financing. And another way to do it, you could actually use your home as collateral to buy something else. So you use your equity without taking out a mortgage, attaching a loan to that house specifically, and still buy a property.
So in this situation, with the rates going up multiple times, as we've already mentioned, would it still be beneficial to do a HELOC and just sit on it, or would it be preferred to refinance?
Well, before I would say refinance because rates were low, and now I would say more HELOC. Because no, I don't want, at these rates, you can't just have money sitting idle.
Okay.
Unless you're going to invest it right away, right? And then there's multiple ways of what you could do with that money. But if you're not going to invest your money right away, don't take it out because it's going to cost you, right?
Yeah.
At these rates at 5%, if you're not making 10, you shouldn't be touching your money, right?
Okay.
Unless you need it to debt payments, family emergencies.
Yeah,
That's
in that
all
case, it
different
would also
case.
work kind of like a credit card.
Yeah, kind of like a credit card.
With
right?
obviously less interest, but
With less
still-
interest.
still.
But that's one of the issues, right? When the market went up, and what they're trying to do is like everybody was using their houses as an ATM, right? So as you can see, there's a cause and effect.
Yeah.
Drop in interest rates raises prices, makes people get into more debt, makes people flush with money, which makes people go buy a bunch of stuff, and then retailers and things increase their prices
Yeah.
because everyone is able to buy more, and then all of a sudden, you know, you don't want it to keep going because we can't grow 20% every year.
No, not
You know what I mean? Because then what? You're like,
Economically speaking,
that's
not
unsustainable.
Yeah, for sure.
Because after a while, a house that was 100,000 is going to be $1 million, and $1 million house is going to be 10 million, and $10 million house is going to be 100 million,
that's also
and then it devalues money. Then money means nothing.
That's why you see some areas like Peel, Durham region, they've been hit the hardest, really. Like you have some pockets in those cities have dropped 400,000, like you mentioned earlier, $500,000 in the course of, what are we in, September? April, May, June, July, August, 6 months.
Yeah.
So,
Yeah, because remember, people buy on payment. people don't buy houses like I'm buying $1 million house. No, they're buying $4,523.18.
Yeah.
That's what I can afford. That's what people are buying, right? They're not buying $1 million. They're like, what can $4,518.23 get me in a mortgage, right?
Yeah.
Now, if $4,524.18 gets me now only 500 grand, that's all I can spend, right? That's what they do. People buy houses like cars. It sometimes doesn't make sense. Like it'd be like, oh, payment 96 months. Like, you know, and that's what it is.
I clearly took up the question period, so let's go right back to you guys. Any more questions that you guys may have?
This question is for Jason. How do you feel about amortization and increasing or decreasing?
So,
And
Oh, like
how
in the
easy-
future?
Yeah, and how easy is it to do that if you have a current existing mortgage?
Well, that's the thing. Like,
sorry to interrupt. Can you repeat the question? Because he was.
oh, okay. So
here.
he asked, what are my thoughts on amortization, increasing and decreasing? So I'm gonna split this question in a couple of ways, right? The first way is like, if your payments are going up, like you could be in a situation, if you've had your home for a long time, you could be in a 15-year amortization left. So what that means, you have 15 years to pay down your home. A simple thing you can do, you can go to the bank and say, I want to refinance to 30 years. You may not ask for more money, but in that case, that could cut your mortgage payment in half. Now, it slows down your ability to pay off your house, but if you remix it with some of the things like we were talking about, we'll put in a little bit extra if you have it, you could actually be the same, but then what happens is you don't every month have to make that payment. So it can make life a little bit easier, right? Another thing is that in the future, if these rates don't go down, what they're gonna do is they're gonna increase the amortization on these mortgages,
Yeah.
because they still want us to
I've
buy.
been reading about that lately.
Yeah, that's next.
Yeah.
There's two things that are gonna happen. If the rates don't come down, they're gonna remove the stress test, 100%, and then they'll increase. You'll see 30-year on insured mortgages come back. You'll see mortgages go back to 30, 35 years, 40 years,
Yeah.
right? Because if you really watch, what really happened was this: Canada, we're such a small country in comparison to the world. We kind of follow our big brother, the US, right? They're massive. So there was a time period where in Canada, we should have raised rates, but we couldn't because the US weren't raising rates. Because if we all of a sudden raise our rates and the US doesn't raise rates, our dollar is gonna spike, which impacts our trade. Because we want our dollar to be a little bit lower than the US, so people will buy our goods because it's a little bit cheaper. But if we start raising rates, what's going to happen, like I say, bonds, everyone's going to be like, I want Canadian bonds because they're paying more than the US.
Yeah.
So I'm going to move my money from the States and Canada, which increases our dollar, which is not good for our trade. So rates were low, real estate market's heating up. Bank of Canada can't raise rates because how it's going to affect other parts of the economy. So then what they call OFSI, which they regulate the financial institutions, they're like, shoot, we need to figure this out. So we come up with a real stress test. And we actually have to approve people 2% higher than the rates. And they came out say like, oh, we're doing this because when rates go up in the future, you're going to be fine.
Yeah.
Which is, as you see, it's actually a good
Today.
thing they did it,
Yeah.
right? In a weird way,
It's happening
right?
today.
So they couldn't raise interest rates to control the market, to decrease demand. So they increased demand by a couple of things: taxes, regulation. And one of those things is like stress tests, decrease in amortization. Because my first home I bought when I was about like 14 years ago, I had a 40-year amortization, and I only put 5% down.
Yeah.
You know, so as if you're talking about 15 years to now, it's now 25 years. You know, so it's like they did little things to try to slow the market because they knew we were having all this population and Canada's becoming more popular and it's becoming a better country, and then people want to come here. It's desirable. World-class city. So
Yeah.
amortization, you know, people can use it as a tool to make their life a little bit easier, but I think some changes in amortization will come unless, like I said, something massive happens and then they start have to drop interest rates. Then they won't touch it.
Yeah. Good question. Yeah.
The thing I see that when I had bought my first house, I noticed that when you bought the house, say for $60,000, you're paying 4 times that thing if you multiply your monthly payment and your yearly payment,
Yeah.
and to the time that you take it, whether 25 years or whatever, you pay for that house all 3 or 4 times.
Yeah, exactly, because the banks want their money. right? So they don't encourage you to pay your mortgage off faster. Just like credit card companies don't want you to pay out your credit card every month. You know, they're a business. They need to make money, right? So it's you have to remember what side of the business you're on. If you're borrowing money from the bank, you're a consumer. So what is their goal? Their goal is to help you buy a home, but they want to make money. You were buying a home as a byproduct of them making money. They want to make money, right? So if you want to take that into advantage, you say like, okay, well, I'm going to pay off this faster, so you get less money from me, right? If you amortize a house over 30 years, you're almost buying the house twice, as they say. So, right? So they make a lot of money. It takes a long time, but you know. And then what we hope is that the value goes up. So in equal way, we got that increase. But then, if you think about it, it's like a catch-22. I want my value to increase, but then what about my son? How much is he going to pay in the future? Yeah. I don't want the prices to go out of reach that he'll never be able to buy, right? Obviously, I would set in place, but you know, you got to think about the greater good of the community. Like it's like it's a catch. So like it's hard. I would never want to be a politician because I understand the tearness. Because you don't want prices to fall because I don't want my like existing homeowners to lose their net worth, but then I don't want to create an environment where young people can't buy. So how do? You can't do both. It's impossible, right? Yeah.
I mean, a lot of people are in that situation right now.
Yeah.
Worried about their kids and their kids' purchasing their property is almost impossible.
But then that's why you have to build that wealth for them, you know? And I think
come up with the actual plan.
Come up with a plan. Help the next generation buy a home. Make sure you use your equity that you have to help other people, because otherwise you're not like that's how the cycle keeps going, right? And that's how, like, to be honest, wealthy people keep getting rich, right? Did you see like Prince Charles is like inheriting like $500 billion, billion in like real estate.
That's crazy.
Like it's nuts. Like she owns. Like I was looking at the stuff she owns. I was holy cow.
Those articles just upset me on a different degree. That's
we don't even get it. Like we're not talking about that. Like leave that. How she got that? That's another question.
Yeah.
We're just saying the fact that she was able to pass on that wealth to the next generation, which is going to go to Charles, which is going to go to William, which is going to go to the other sons, which is going to the next generation, right? Yeah. That's what it is, right? Because she had to, or even before her, had to think about the next generation, right? So it was a deliberate action that what they did, right? So we have to do the same thing. Like we can't just let these institutions take advantage of us. We got to be deliberate with our actions, right? And our plans and what we're doing.
And then the thing with her, she put no tax.
Yeah, of course.
They can't tax them.
Yeah, or she bought life insurance. That's probably what she really did.
Yeah.
Okay, I have a question for someone else. But with refinancing your home, so my mortgage is due to renew like October.
Yeah.
Right? Do you have to go through like another stress test or check?
You have to go through the whole process.
The whole process again?
Now, the only thing you do without going through that, you can just renew with your bank. So your bank they probably have already sent you a sheet and they're saying, here, you could take a 1, 2, 3, 5 year. You don't have to requalify for that. But if you want, like, as I was saying earlier, you could be like, you may only have 10 years remaining on your mortgage. You may say like, oh my God, at 10 years with this new interest rate, I can't afford it. If you want them to extend that out, you have to reapply for that. You have to requalify. Yeah, because in essence, it's like a new mortgage. It may be the same amount, but it's to the bank, it's like now it's a different term. It's a different situation.
So they go through everything.
Everything. Check your credit. Check your, check your blood type. All the stuff they ask for. What's your blood pressure? No, I'm just playing. They don't ask that, but it seems that way, doesn't it? Sometimes, like that's why I always tell people. Like after I do a mortgage application, I sometimes know more about you than your spouse. Right?
I went to the bank in Jamaica to open an account. So what they don't ask is what is not there.
Yeah.
So I said to the lady, I said, next time when I'm coming, I'll bring up pliers. She said, why? I said, for you to take out the teeth, because the only thing you don't want.
That's funny. It is true, and it's like, unfortunately, if you were lending money or you were operating a business, you'd want to know who it is. This world, and some people are not nice, right? So there's a lot of evil stuff that happens, right?
Okay.
So once you're in an existing mortgage as well, you cannot extend your amortization at all?
Without
Or you have to
renegotiation.
reapply?
You have to reapply.
Okay.
The only way you can do it is, right, is if you do what you were talking about, you prepay. So in some cases, contractually, you may have 15 years, but because you've prepaid, you only have 7 years remaining. But then you can always ask them to go back to that 15. You only can go back to where the contract is, right? So like, for example, in your situation, let's just say you were on a, like I talked about, like a fixed variable rate payment. Now all of a sudden you're supposed to be 15 years, but because your mortgage payment hasn't changed, the bank's like, oh, now you have 18 years remaining because all the added interest. They're gonna say you have to bring it down, or you have to reapply or refinance, right? So it's like there's different ways in which they do it. And like this is what I'm saying, 18 months. Because like now it's gonna be like people are gonna renew next year, people are gonna have mortgages, their mortgages are gonna reset, their payments are gonna change. That's where things, it takes time for it to run through the system. So I feel like what they're hoping, they're purposely trying to crash the market
I was going to ask you that
to
next
speed it up.
So my question was going to be, do you foresee, because it's going to take some time to settle in, that there's going to be an influx of homeowners that can't afford their property?
100%.
Has to sell their property.
100%. It's coming.
Otherwise, the bank will take it back. And
The
sell
wave is
themselves.
coming.
Yeah.
And you have to remember, there's going to be some people that will actually have to lock in at these type of rates. And all of a sudden rates have gone down and they can't remortgage, right?
So like
Yeah.
2 years from now or whatever.
You know, so that's the thing. And there's, for example, there's a lot of people who took B rates and B lending and even private loans that those lenders may not renew for you. They may be like, no, I want out. We're not giving you the money
That's a
anymore.
sticky situation.
And then all of a sudden now you don't have a mortgage, you
Yeah.
may not be qualified with a bank. So that's why I was saying at the beginning, now is like no matter what your situation is, whether you can afford your mortgage, you can't afford your mortgage, still budget and look. Because your mortgage may renew in a year, 2 years, 3 years. Most people take 5-year mortgages in Canada. That's a disadvantage. In the States, they take 30-year mortgages. So you don't have that period, right?
Yeah.
Us, it's like 5-year terms. 5 years is not a long time.
Goes by in a blink of an eye.
Like that, right? And if you were the B lender, it's like 1 year, 2 year. So I know some people, I gave them B loans, and I remember last year, one of my clients, I was like, you gotta take this 3 year. And he's like, oh, I'm taking a 1 year. I was like, no, take this 3 year. I was like, I don't know next year if you're gonna be able to qualify.
Yeah.
And he took it, and he called me the other day, and he was happy. But at the same time, I have some clients that I put in variable, and I'm telling them, like, you gotta ride the wave, you know? Like, that's, at this point, you made that decision that you were comfortable with that fluctuation. And yes, it's not in your favor at the moment, but it can reverse.
Yeah.
Like I remember in 2017, I remember this clearly because it's actually the client was my cousin. So excuse me, I gave him a variable rate, and then variable rate went up, you know? So he calls me, and he's like, I thought I was on a fixed rate. And I'm like, no, you're on a variable rate. We talked about this like 7-8 times. So his payments started changing, so he started getting upset. And I was like, listen, just ride the wave, you know? And I was looking when rates were going up in 2018, 2019, before they paused, I was like, something's wrong. They shouldn't be raising rates, because I don't think the economy was that strong.
Yeah.
Lo and behold, I didn't know COVID was coming and all this kind of stuff. But then now what ended up happening, the rates went down, he started saving much more money, and then he got all happy. He was just like, oh, thank you for my variable rate. But I never reminded him the time he cursed me.
Question: what if your company don't allow you to make additional payments
Most companies do.
until the anniversary?
If that's the case, then unfortunately, the only thing you can do is really start saving that capital and putting it aside, and then like either put it in a savings account or invest it. But if they have a strict rule on that, all you can do is set aside the money for the future. You can't get that compound effect by paying down the mortgage and reducing your interest.
For anybody who didn't hear, the question was, what happens if you have a mortgage?
With more interest?
Pardon me?
What are they trying to do? Limiting you paying a little bit more
Additional
interest?
They want you to pay more interest. So what he's asking is that, why would a bank not want you to put more money down, right? Until your anniversary. It's because they want that money that they have stipulated in your contract, right? So they're like, no, that's my business. This is how I make my money, and you can't do it. But in some cases, because a lot of times what happens is, unfortunately, when we sign mortgage papers or all these documents, there's like 70 million papers. Like you have no idea what's inside any of this stuff. You know, and to be honest with you, it's done that way on purpose. So the little intricate details like that. Like I'm sure if you knew when you signed up for your mortgage, you possibly couldn't do that. You probably wouldn't have took it. You would have asked for a different product or whatever, right? But you know, it gets masked in these products. Like, I remember I worked for BMO, and they had this mortgage. It was like a low rate, smart mortgage, and you couldn't even refinance with another bank. You could only do something with BMO, and the only way to get out of it is if you sold your home. So I remember when I was there, I'd never sell the product because I'm like, why would I sell it? Even though it was a lower rate for a client,
Yeah.
I wouldn't sell it because it doesn't give you the options and the flexibility if you want to come out of it. Because I remember one client, one client actually went to the ombudsman and got it reversed because he said he didn't know.
Yeah.
You know, how you sell a product, you're not telling somebody that, you know? And then that's it.
I mean, that client was lucky. I'm sure there's been a lot of others who weren't so lucky.
Well, most people won't write.
Yeah.
Most people will just say, oh, I can't do it. Okay, I'm not going to do it. Other people will be like, what? I'm going to fight. Like, someone lied to me. Someone misled me. I don't care. I'm doing this. And if you want, like, let's go. But then when you complain to the bank and it gets to a point, they don't want that customer story to go into Toronto Star,
Yeah.
how the bank wouldn't let you pay off your mortgage, you know?
Yeah.
And that client actually got like an inheritance and he just wanted to pay it off. And they wouldn't let him pay it off with the money he had. And it was bad.
Sounds like a horror story.
It was, well, I remember I was a teller back then and I was like, oh, I was manager.
Any
So-
more question? Because I have some questions. Okay, go ahead.
First, can you quickly explain what a fixed variable is? Because every time I see that, I renewed my mortgage recently, and I was like, I thought it was one or the other. How is it both? Like, how can
So a fixed variable rate is that your payment stays fixed throughout the whole term. So it's a variable rate. So the interest rate change and the amount of interest that you pay on your mortgage will change, but your payment doesn't, right? A non-fixed variable rate, the payment fluctuates as Bank of Canada raises the rates and the banks change the prime. So in this case, like for example, if you're on a fixed variable rate, this whole time your payments hasn't changed. And if you don't look at your mortgage, you think, oh, rates haven't gone up for me, right? But unfortunately, when you look at if you look at your bank statement, you'll see that your amortization has increased. Like something's changing, right? But when you're on a fluctuating variable rate payment, your amortization stays as the contract, so your payments are going up.
And then the other question I had, my dad owns like 10 properties. They're all single dwelling units.
Yeah.
And I want a multi-dwelling unit, and you mentioned 4 versus 5 doors.
Yeah.
And then there's a difference in qualifying for that. Does it make sense to have a bunch of, like she said, about the 30 properties with different, lenders versus just having a building?
Go ahead.
So I'll just give you, in my opinion, but he's a finance expert, obviously. I would recommend doing a building with multiple dwelling units. Continue, and then I'll.
It all depends. To be honest with you, it's all about cash flow, right? So buying individual houses has its benefit. Like if, for example, you just need, let's say, for example, you need like 500,000 because you want to build a house back home, right? You can sell one home. But if you have a building, you can't just liquidate 1/5 of my building to do that, right? So it has its advantages, right? The other advantage is if you buy one big building, you only have to go see one place. You could have one property manager. It's not all spread out the city, right? But then the thing about it is most people, it's hard to buy a building. So the way most people accumulate is by doing what your dad did in one by one by one, and slowly start to build, because buying a building's hard. It's the financing is different. You have to go see a different person in the bank or a different mortgage broker that specializes in commercial. It's a different animal, so most people just do what's easier. But if you ask my opinion, I would go for multi-unit all day. Like I would just buy a whole bunch of multi-units because to me it's easier to manage. Like I'd rather go to one place, deal with 10 tenants in one building than deal with 10 different houses, 10 different roofs, 10 different, So yeah, but
Also, the vacancy rate. Sorry.
Vacancy too.
Vacancy rate.
Yeah,
So if your one house is vacant,
right,
who's covering that?
right.
If you have multi-dwelling, you have 2 vacancy rates, the rest of the tenants are covering that,
Right.
right?
less risk. You're right.
Less risk, sorry, yeah.
And that's how I felt about that. And so how do you qualify? You said that your income your personal income, I guess, isn't considered.
It's not that it's not considered. It's just not, like, for example, if you make, like, when you buy a house, they include your income in the servicing of the debt. What the bank does, it's like a consideration they make. So say, for example, you buy a property, but the mortgage payments don't cover, the rental income doesn't cover the mortgage payments. The bank may look at your income and say, you know what? She makes a great income. She can cover that shortfall. We'll give it to you, right? But at first, they're only judging the property on its own. Is it self-sufficient on its own?
The commercial property. And if you have, when you mentioned doors, if you're renting rooms, those aren't considered doors.
No, and banks don't like that. So never ever say that out loud. No, just play. No, but the reality, rooming homes, banks don't like because it's like, sometimes I don't even understand, because to me, income's income. It's money, it's coming in. But like, I think there's a risk, especially with student housings, they're going to destroy the place. The turnover is quite high, right? If you're renting a room, you're more likely to leave than if you had your own apartment, right? So there's all those stipulations, and like I say, the banks look at it as risk. I'm sure if you go in the risk department, they have all these manuals that say this is why we don't like this, right? I'm looking at it, I was like, that's money. It's coming in, it's consistent, it works the same. So what people do, if you have a room in home, you put everybody on one lease. So that's what that avoids it, because then to the bank's perspective, it's only one income you're coming in. So me and you and all of us can go buy a 20-bedroom house and all live together and be cool, right? But to the bank, they don't want to see 20 leases going to Maurice, you know? One lease, so we'll all be on one lease as a collective, and like, yeah, that makes sense to the bank.
Yeah. Any other questions? Yeah, go ahead.
My question is, I think a contract, when you sign a contract,
Mm-hmm.
and if I kind sign a contract for 20 years,
Yeah,
is it supposed to be there till the 20 years?
yeah, it's a marriage.
So why is the bank, every time they keep, at 5 years, they come to change your
Ah.
contract that you sign?
You don't, okay, so your contract is for 5 years with the bank, but your amortization, the time they get you, is 30. So you don't have so what happens is every 5 years, you're signing a new contract.
Okay.
So that's the difference between Canada and US. We're termed 2 years, 1 year, 3 year. You never hear that in the States. It's like 10-year, 15-year, 30-year mortgage. They do it differently. Their terms and their amortizations match. Ours don't.
Because I know if you sign a contract to buy a car,
Yeah.
it stays there till when it's finished.
Yeah, but that
And
car's not
every
gonna
time-
last.
Every time they change in 5 years, and I want to know if a contract is a contract, or you can break the contract. Now you explain the kind of.
And it's good for them if you think about it, because every 5 years it resets. So if rates go up, they make more money. If rates go down, they still make money regardless. You know, they just make money. All right.
Thank you, my dear. That's what I have to say.
All right. Is everybody all right? Anything else? I feel like I covered a lot, man.
You definitely covered a lot, more than I thought you may have covered, or
Yeah.
expected to cover. So once again, thank you very much for joining me on, sorry, you had a question?
I just,
Yeah, it's okay.
with the Canada savings bonds, can we still get that? I know years and years ago.
I have no idea. You know what? They probably do have it, but people don't buy it because what happened is this. When you're thinking of Canada savings bonds, probably what you're thinking about it, back in those days, it was like 10, 12, 30. It meant something. But remember I was talking about bond rates. So you said something really good. Canada savings bonds are bonds. The same thing where they borrow money to fix our roads, all that kind of stuff. But what happened was as interest rates came down, who's buying a bond for 1%? Right? And that's why no one talks about it now. But the funny thing is, interest rates are going up. So now they're becoming more relevant now. So now people may talk about it. Yeah, it's not often you hear people talk about savings bonds as they did in the 90s. Because they were really important back then. You know? And before, governments used to want to raise money from our citizens. So back in the day, all of our debt, like if a country, the debt's usually the citizens that buy the debt, right? Now we have like pension plans, foreign companies buying our debt. Like it's more of an international market. But at those times when they created savings bonds, it's just like, yay for Canada. Like I'm investing my money. I care about Canada more than anything else. There we go. That ends the podcast. But yeah, like that's kind of the scenario. But you don't hear they exist, but no one buys it. Yeah, people buy. What you do, you go to the bank, and the bank sells you a money market mutual fund, and then they buy Canada savings bonds in there. That's what they do.
So I want to thank everybody once again for coming out today. I do have a little gift for somebody who can answer one question based on what Mr. Alan John discussed. Simple question: who could raise their hand quickly to tell me what the mortgage rate or the interest rate is right now?
5.4.
I mean, sorry, Shaq, right?
Yeah.
Is that
Yeah,
right?
he's right. He's right.
He's right. Okay. All right, come on up. Get your gift card. That's cool.
Yeah.
Why not? Thank you.
No problem.
Appreciate it.
Everybody
Those shoes
has
are cold, Shaq.
Everybody has a piece of paper underneath their chair. If you could take a second, because this is the first seminar that I've personally held since COVID, I would love to get your feedback. Just fill it out. It's a 5-part questionnaire. And there's also a book in there called Real Estate Investing that will help you understand how to invest in real estate. If you ever even need to sell your own property, there's a chapter in there as well. Give me feedback on that if you don't mind as well. And once again, Jason, thank you very much for joining me on my first podcast. Let's spark a conversation with your host, Maurice Anderson, and this has been sponsored by In Motion Media.
In Motion Media, shut up. Thanks, guys.
So do we have access to this?
Yeah, I'll send you a
Happy New Year.
Definitely need to pour more champagne in these bottles. I mean, these glasses.
But you definitely don't want to make everyone drunk.
Sorry?
You definitely don't want to make everyone
No,
drunk.
not at all. But like at least quarter. Some of them have like barely any in them.
The sip.
Yeah.
They drink whiskey, like sip.
What time is it?
9:47.
Not really that bad actually. I'm gonna run to Tim Hortons to get a box of coffee
Mm-hmm.
for anybody who doesn't like mimosas.
Okay.
And that should be it until the guests start coming in. I'm surprised this bottle is literally almost done.
Really?
Yeah. Good thing I got tea.
And one for me.
Hmm?
And one for me.
Definitely we can get you a bottle after.
Yeah.
You
That's
drink champagne or sparkling wine?
Yeah, I can drink that a little bit. Have a party night, but one glass won't be a problem.
Do me a favor?
Yeah.
Can you actually also record one vertically with my phone so I can post it?
Okay. So I can put it here, or I can do it here.